Good afternoon, everybody. This is Paul Spirgel. You're in the week ahead in Forex trading, brought to you by Forexfolio with an assist from FX Street. Before we get started, let's take care of our usual disclaimer. Foreign exchange trading carries a high level of risk that may not be suitable for all investors. Leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research, data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Forexfolio expressly disclaims any liability for any lost principal or profits without limitation which may arise directly or indirectly from the use of or reliance on such information. Okay, good advice for everybody. Be prepared. Just a couple of little key points of economic data that are coming out this week. Tomorrow we've got Case-Shiller, which gives you a little look at the overall housing environment here in the United States. As we've said repeatedly, to this point, housing and employment are the main drivers of perceived U.S. economic recovery. Until we get some positive momentum in those areas, you could expect the vacillations in data that we've had to continue. Moving along, Canada has retail sales. Also, gives you an idea of the relative health of North American economy, U.S. new home sales, and U.S. consumer confidence. Wednesday, I've put this piece of data in red because this probably is the most important piece of data of the week, the U.S. FOMC rate decision. There's no change expected, but keep an eye out on the language that the FOMC gives when they announce some of the key points within the FOMC, the previous FOMC meeting, expecting some more hawkish data which may spook the market into thinking that the U.S. is going to hike rates sooner rather than later. Again, it doesn't jive with what Mr. Bernanke has been saying for the last couple of weeks, if not months, but again, you get blips up and down based on headlines, so you have to be cognizant of that. We also have U.S. durable good orders and U.K. GDP preliminary release. Thursday, we've got assorted Japanese data coming out, the index of all industry activity, unemployment rate, Tokyo CPI. These are important pieces of data out of Japan, but again, the big noise out of Japan will be whether or not the BOJ is going to take any more easing strategies down the road. What else do we have? U.S. pending home sales as well on Thursday. On Friday, which for our purposes is probably late Thursday night if you're in the U.S. or North America, late Thursday night or Friday morning, the BOJ will announce their target rate. Again, no change expected. Keep an eye on the language. And later on in the day, we have German consumer confidence and the U.S. consumer spending and GDP. Again, as with all data, it needs to be taken with a grain of salt, and we have to keep in mind what the prevailing market and sentiment is, and we'll get into that a little bit later down the road. Again, for what we've got looking forward a week ahead, again, you can't go ahead without looking back in the foreign exchange markets or in any of these markets in general. And the recent data, particularly out of U.S. and China, has been mixed. This yo-yo effect has kept major currencies in a tight range, and for the short term, we continue to go release to release. What this means is that the market really hasn't made up its mind. Using the euro as a basis, as you know, if you've been watching lately, we've been trading in a 129.80 to a 133.40 range. And again, it seems like every other piece of economic data coming out of the U.S. and China says rates higher, rates lower. So until we get that one piece of news that moves the market through some of these support and resistance areas, we're just going to keep vacillating back and forth. And I mentioned U.S. and China and not Europe. For the most part at this point, Europe is really not anywhere near the a leadership position. The Germans, while the Bund has hit record highs lately, that's more for safety, and while the German economy is showing good signs of economic activity, the mere fact that it's so close to all these other economies that are in such bad shape, nobody's really expecting any good news out of Germany. If anything, the only news you can get out of Germany would be more bad news if Germany starts to take a larger role in the bailout of the overall European situation, and that would pretty much detract from the good news that's coming out of Germany as it is now. So again, be cognizant of that. If Merkel decides to take on a larger position in the bailout of Germany, that will only weaken the German position relative to the rest of the world, and specifically to the rest of its European neighbors. More European news on our second bullet point here. We had the first round of French elections, and the socialists seem to have the upper hand against Nicolas Sarkozy. The biggest surprise was from Marine Le Pen's record 18.1% support. And the reason for this is, with all the economic crises and the weak economic activity going on, much like the perception that in the U.S. in 2008, everybody was voting for Barack Obama because they wanted to try something radically different. In the U.S.'s case, a president with absolutely no experience. But again, people are trying to think outside the box and do things that'll stir things up and get some new thinking in there. Well, we'll see how it works. It hasn't really worked that well for the U.S. Again, we still have some nice unemployment here as well, but things have definitely settled down. So good luck to the Europeans in that. And again, in the U.S., we've had some strong U.S. earnings reports lately. It's been consistent with the view of modest growth for the first quarter. Again, the prevailing sentiment has been that the U.S. is in the best shape out of all the major economies, and most of the earnings data we've had out recently has underscored that as well. Again, the twin problems of housing and unemployment still remain, but along the way, incrementally, at least the companies are making money. As you say here, disappointing initial jobless claims and sluggish housing market have increased concerns among investors about the growth will continue into the second quarter. And this is just an observation while I was speaking to a few research people that I speak to. They keep mentioning how 2010 and 2011 had similar moves within the market as 2012 is. That it means that we entered the year in this great euphoric spin that everything's going well. And then as we got to the summer, that sentiment has eroded a little bit and has encouraged further action by the Fed. We've got the same thing going on now. We're hearing more and more talk, particularly out of this meeting. If it doesn't go as well as planned, the market is hungry for more quantitative easing, which leads some people to believe that this recovery, or the stock market, or the S&P being around 1,400 where it is really just a function of the easy money. And if we don't have that easy money, we're going to fall back. So don't trust this recovery just yet. Some more sentiment issues in the euro area. Obviously, the sovereign debt issues are the big issues of the day, and in particular concerns about the Spanish 10-year yields, which for now are hovering around 6%. Like we said last week, the big bogey in this area would be anything north of 650, 670 would signal some real serious consequences for Europe in general. And the feeling in the market is that should we get up that high, there'd be some swift intervention by some of the European governmental entities. So be aware of that. And in that vein, with the Spanish yields rising and being that the markets are a touch spooked at this point, there's news of the IMF receiving firm commitments of around $430 billion as additional resources. This has helped lift some of the spirits relative to Europe, but as I'm saying here, these contributions haven't been decided yet and are conditional on broader IMF reforms being adopted. And there's explicit mention within the IMF statement that the funds aren't earmarked for a certain region. Obviously, the IMF doesn't want to just say that we're going to take all this money and hand it right out to Italy, Spain, and the other peripheral countries that are having trouble. But the fact that there will be more money sloshing around the international system for bailouts and economic interventions is a positive sign. And my last bullet point on that is the U.S. and Canada continue to push back on the need for expanding IMF funding, and the reasons being this type of kicking the can down the road rather than implementing clear and necessary reforms should keep the Eurozone and the euro itself weak for the next few quarters. I wouldn't expect that the Eurozone would rally anytime soon. Again, all of the suggestions for fixing Europe to this point are more based on liquidity, not in any real serious reforms in terms of government charters, government spending. So, you talk about austerity, but austerity is great, but you still need growth as well. And the way that the diplomats are talking now, they're looking at an either-or situation. There are no surprisingly good ideas about how to do both, because you really need growth as much as austerity to bail the Europeans out of what the mess they've gotten themselves into. And for the next week, dollar yen will be in the spotlight. We do have we're likely to have a bumpy ride with the FOMC and BOJ announcing rate decisions. We don't expect any change in rates, and we don't expect any change in monetary policy stance by the Fed. There's a probability that the accompanying forecasts show the FOMC members as being slightly more hawkish. As you recall, the last few meetings, there's been more talk about rates going higher sooner. And again, this doesn't jive with what Fed Chairman Bernanke has been saying. We've mentioned this many times. He's been likening this recent crisis to the Great Depression in the 30s, and his feeling is that the reason the Great Depression took longer to get out of was because the Fed raised rates too early. So he is on record as saying he doesn't want rates moving higher before 2014. The only problem is along the way we get some of these economic data and earnings out there that make it seem like the U.S. is starting to heat up a little bit, and the market itself is saying, well, if we do start overheating, they're going to have to raise rates. But for now, Bernanke wants everybody to understand that there is no plan in the near future, even in spite of what might be perceived as hawkishness by some of the FOMC members. So that kind of headline noise could wreak a little bit of short-term havoc on the market. So again, as long as we stay within our greater support and resistance levels, which for now is, again, that 129.80-90 area and 133.70-80 and 134.80 figure, expect to keep playing the ranges for now and leave stops in the right place. And as far as the BOJ, talk is that there's an increase in the size of the asset purchase program by 5 to 10 trillion yen is likely by at least the middle of the year. As we know and as we've said, the Japanese want dollar yen higher. The asset purchase program is a method of quantitative easing. It's a way of cutting rates. And as we've said, theory number one, when you cut interest rates, you weaken your currency. So the Japanese have made no bones about the fact that they want, at a minimum, the dollar yen to be trading at 83 to 86. I'm sure they have no qualms if they could get it up above 90. But sitting where we are now at around 81 and a quarter, it does not help them. It's a lot better than when we were at 75. But as far as the Bernanke, mandate is that he's not going to be raising rates before 2014. The Japanese want dollar yen higher. They want the yen to weaken. Their exporters are getting killed in much the same way as the Swiss and the Canadian. The other safe haven areas are getting killed because of having too strong of a currency. So, again, don't let any interim data obfuscate what's going on out there. The Swiss, the Canadians, the Japanese, they want their currency weaker for export reasons. The U.S. actually wouldn't mind or needs that their currency gain a little strength now, because that strength would be good strength, as it would send a a proper signal to the market that the recovery is well on its way, and then we could potentially be adding more jobs. But that's a deeper economic story for another day. Or if anybody has any questions down the road, we can go into that a little further. If anybody has any questions at this point, feel free to let me know. I'd be happy to clarify anything I've said so far, or anything you guys are interested in. I'd be happy to help you out with. All right. We got FX pips typing in. My view on the Aussie interest decision. I don't expect any changes in Aussie interest decision. I do believe they're going to start cutting rates. I think we've got New Zealand, though, coming up earlier this week, and not Aussie. And again, I think they're going to keep their interest rate where it is. I think there's a very good chance that the Australians are going to be cutting rates. They're also not too happy with the strength of the Aussie dollar. And again, the Aussie dollar has come under a little bit of pressure lately. If you witness the move, particularly against the Kiwi, a little bit of the euro, Aussie is a touch lower on a relative basis. And the Australians would be more than happy to see definitely below 95 would be what they're looking for. And again, they were cutting rates a couple of months ago, and they stopped to see if their rate cuts would be having any bit of an effect. They've had small effect, but I still think a lot of these other, again, the Aussie has also been a safe haven, and these higher rates are killing them, particularly in that the Chinese economy seems to be starting to slow. China does a fair amount of business with Australia because it's one of their closest, more developed neighbors. So if the Aussies can't count on China to be taking a lot of their product at somewhat more inflated prices because the Chinese are losing a bit of their economic fervor, is this weakness pricing in the cut? Yes. The Aussie experience is one that they're expecting rate cuts, and selling ahead of rate cuts is what the market does. I don't know if you remember a couple of weeks ago, we had that big move up from 103 to like 106. They were expecting a rate cut. They got none, and everybody just exploded higher. Aussie Canada, Aussie Kiwi, Aussie dollar all took off higher. So there's a lot of speculating on interest rate cuts. And again, the feeling is that rates are going to be coming down in Australia. The fact that not much has been going on in terms of overall macro noise, it seems like now would be a good time for them to start cutting rates. So beginning of next month, I would definitely expect something to happen there. Thank you, FX Pips. If there's anything else on that vein, I'll keep moving. Again, talking about interest rates. We've got rate decisions in Kiwi, yen, and the dollar, all expected to remain at current levels. Again, like we always say, pay close attention to the language. In the dollar, sentiment is for a more hawkish stand, which should be balanced against Bernanke's desires to keep rates low until 2014. And in the Kiwi, watch for the RBNZ to mention specifically that the relative strength of the Kiwi dollar is hurting exports. That's the surest signal that down the road they're going to be looking at ways to cut rates and to make the New Zealand dollar more attractive to foreign investors. Not to foreign investors, but for their exporters to go out and sell at a more competitive rate. As always, pay close attention to the PMIs. PMIs have been weaker in Europe, which again has had the effect of raising Spanish and peripheral bond yields. There's a lot of fear. There's still more of auctions that are going to be going on in Italy, Ireland, Spain. And so as the PMI, it's all about the economy now, to paraphrase during the George Bush elections. It's the economy, stupid. That is going to be the driver that's going to save everybody down the road. We need better economic growth to pull the world out of its economic doldrums. But pay careful attention to Germany itself, because up until this point, Germany, as we've said, has been the lone, real economy that's been going gangbusters in Europe. If they get more involved in the bailout, that could hurt Germany and hurt the euro itself. So I would watch that. For now, the euro's, has this relative strength, because realistically, with all these euro participants being in significant trouble, you would have thought the euro would be down at 120 already. But the fact is, the German Bund is at record low yields, like 1.6%, and Germany itself is doing well. The fact is that the euro is made up of so much German, I believe, like we said, anywhere between 56 and 63% of the euro is Germany. So the fact that Germany is doing so well and it's such a safe haven, that's what's keeping the euro up. But if that perception that Germany is doing so well begins to erode or fade, you could expect the euro to go the way of the British pound and just not have the respect that it has at this point. And again, as we're talking about the economy, in terms of the U.S. relative to Europe in earnings, the U.S. companies have beaten estimates on 85% of earnings and 85% of earnings per share and 76% of sales. In the European arena, this ratio has been nowhere near as good. It's been 60-40. So the key thing to remember at this point is that the U.S. remains the global growth leader. The U.S. is definitely perceived at this point. And again, not to beat a dead horse, notwithstanding unemployment and housing markets, which could turn and bring the U.S. down, at least in terms of its overall perception. But, the Chinese are having issues. The Europeans are clearly having issues. The emerging markets really need something else to feed off. So for now, the U.S. is running the global asylum, so to speak. And that's all I have for particular news and other sentiment type issues. And if anybody has anything they'd want to look at in specific, by all means, let me know. If not, I will take a look at a few charts. All right, here come the charts then. Let's do it on the smaller chart. All right. What we have here is a euro chart. This is on a 30-minute time frame, and there's nothing new here for us for the most part. Let's actually step it up to a daily so we can get a longer time frame in there. And this is really what we've been talking about. This 129.80 to 134.80.90 is the larger range. Expect this to hold, and again, inside of that 133.70 area up top. So for now, we're still looking at this touch below 130 the figure to 133.80 as our initial target area. If we get no movement out of that, expect this range to keep going on. And again, unless there's some serious, excuse me. Is that better? All right, Sam, thank you. Again, as I was saying, this is the greater range, 134.70, 580, and 130-ish, 129.80 on the longer to 130-ish. There's nothing in the short term that's going to be moving us out of this range. If we do get that move, as you can see here in the euro, we've got periods of low trading activity. These long bars just mean they're quick moves, so you've got those to fill. So again, you could see easily 128 and a quarter below that, even going down to 126 and change. Up top, if we get a move above 134.75, you would expect we can get, it's a long way. First stop would be 135.50, but if that goes through, we could get a move up to 138 on this daily chart. But again, every 50 to 100 basis points or pips above 135 is going to be a tough road to go. My particular feeling is you want to be selling strength in here. You want to be selling strength in here. You may want to move a stop at 135.40, between 135.20 and 135.40, just to see if this plays out. But again, if not, if we make a move below 134.80 after that, I'd be selling stop in. My bent is to be selling into any strength here. In terms of overall European sentiment, there's still a lot that needs to be done to bail out all these peripheral economies. And that being said, I know we've been talking a lot about 120 in the euro, and we haven't even gone below 130 in the longest time. But that is still in play. I mean, there's no good news that we've gotten out of Germany. Merkel or Sarkozy, and with new leadership looking at in France, there are problems going on in Holland now that the government's having no confidence votes. So there are some issues here. So I would consider any real strength in the euro area as something that needs to be sold. So keep an eye on that. Let's see what else we got. Let's take a look at Euro Swiss again. We've been looking this off and on, and again, we know that the floor at 120 even has held. It took one little quick flyer down below over here, and there's we keep compressing lower and lower. I'm of the opinion that at some point the S&B is going to move this band higher. I think if you have the opportunity to buy an option, even a 121 and a quarter Euro Swiss call, 3 to 6 months, you might want to buy that until we get a significant break below at 119.60, which again I think would only happen if the Iranians do something silly in the Strait of Hormuz. But for now, there's just this meandering compression lower in the Euro Swiss. But I think S&B President Jordan at some point is going to make a move and move this band higher. I think these lingering doubts over the 120 band, if he doesn't get ahead of his problem shortly, he's going to have significant problems. What else do we have to look at? How's about dollar Swiss while we're talking about it? Big sentiment in dollar Swiss is that everybody's expecting the dollar to go higher for the reasons we spoke before about the yen, the Canada, the Aussie for that matter. These safe haven currencies are definitely not enjoying this strength. You would think at some level that these companies would be very pleased that their currencies are showing strength, because really on some levels the strength of a currency shows the strength of a country, but these are too far. This strength has just wreaked havoc on the exporters. I mean, they just cannot be competitive. The Japanese are getting destroyed. They're trying to sell cars, and when they repatriate their assets, they're getting nothing back for it. I mean, if you think about it, if somebody's going to be buying a car, and they're only giving you 80 yen for it as opposed to a couple, 90 or 100 yen, it's not what you're looking for. You really have to, GM and Ford have such an advantage over the Japanese now because of their ability, on a dollar basis to sell for a much cheaper cost than the Japanese have. And it's happening throughout the world. The Germans have the same issue with Audi and then Mercedes, and even the British to a degree, are having issues now that we've popped above 161. So again, the Swiss, tiny little country, has some good manufacturing, but the reason that Jordan will probably have to do something in the Euro-Swiss area is because the Swiss exporters can't competitively sell, and it's just destroying their countries. What else do we have here? Let's take a look at gold. Let me just refresh this. Gold really has been tracking nothing lately. On a relative basis, it's been tracking U.S. yields. As U.S. yields have been going lower, gold has been going lower with it, which is counter to the prior trend, because what we had seen in the past was as the U.S. yields would be going lower, gold would be going higher. The reason for that being that if you weren't earning anything on your U.S. assets, you may as well be in gold. So that actually underlines the fact that there may be more to this U.S., or the market is thinking there's more to this recent U.S. strength than there was in the past. I myself don't believe it. I think the U.S. also has some significant issues that need to be addressed. And I think gold down here at 1635-ish is it can be bought. I'd watch a 1590 stop, and below that a 1540 stop to add and go lower. So for now, gold anywhere between this 1620 and 1700 or so is really just try and trade ranges. Sell it at the top, buy it at the bottom. Unless we get a significant move above 17 and a quarter, and we try to fill this gap here all the way up to 1790, I think that's what you want to be doing. Just looking to sell loops between 1660 sellers and 1620 or so buyers, and anything close in between there. What else? Cable, as sterling is affectionately called. Cable's had a recent bout of strength, and again, the only thing that this says to me is that there is a lot of fear going on in Europe about the overall strength of the European area. I mean, the only reason why anybody would go out and buy sterling over euros is that you expect that the Europeans are going to be dragged deeper into the quagmire of Europe, and that's what we're seeing here. The British economy is run largely based on what's going on in Europe, and as we've said repeatedly, there's not much going on in Europe. So for that, keep an eye on Europe. Look at this 162, 161.80 area is a good area of resistance, and try and fade that one if you can. And that's what I got in cable, and I'll throw it back up. Anybody have any questions? Sorry for that. Or any other charts that they're looking at? Again, we'd had some queries a couple of weeks ago about the S&P, and I'd mentioned that 1400 would be a good area. We've gone down pretty severely from there as well. So strange things are afoot in all the markets here. All right, let's take one more look at another old favorite of mine, the Aussie Kiwi. Again, as we had that question before about what do I think is going to be happening in Aussie. If you notice, what this shows here is this area here is weakness in Aussie, and again, in anticipation of rates. Now, as I mentioned before, there is some talk about Kiwi and worries about the Kiwi strength. That being said, we notice that the Kiwi has started to move back a little bit higher. So, this is really just a fight between Australasian interest rates. And what's going on here is, At this point, it was going to be all Australia cutting rates, and the Kiwi weakness would be done because the Kiwi had been cutting rates, and over here is where sentiment started to turn and look like the New Zealanders, the All Blacks as they're called, would start cutting rates as well. So as we get closer to the Kiwi decision, we'll get an interesting look. At this point, obviously, it could go either way. We could see Aussie Kiwi shoot back down to 125.60 or back up to 126.70-ish, or even here 126.25-ish. So it's not much of a coin toss. I personally think that even if the Kiwi people say or do something, that the Kiwi people, sorry, the New Zealand, the Kiwis, the New Zealanders do something, the overall mood is going to be that the Australians are still going to have to cut rates. So at a minimum, they're going to be keeping pace. So I would think Aussie Kiwi would be a sell. And if you get the opportunity above 127.80 or so, or even 127.50, look to start selling a touch. And again, this smacks to me of one of these areas where, something will come out news-wise, it'll fire up here, and then next thing you know, it'll come all the way down. So thank you, Sam, for your defining the ethnic New Zealanders as the Maoris. So there you have the Kiwi story as seen through the eyes of the Aussie Kiwi. Anybody else looking at any particular areas? Nope. All right. Let me give us one look technically at dollar yen here. All right, dollar yen. What do you do with dollar yen? It's been quite an interesting ride here since last November even. For now, we took a little run back lower at 80, and there was some talk coming out of the BOJ that they wanted things to go higher. For now, I think, as we saw initially, the move higher that sustained us above 80 did come at around 80.20 to 40. Use that as your area of support for now. If we get a move below 80.40, I definitely think you're going to want to sell into that. Definitely if we go below 79, 70, 80. On the upside, we've been staying pretty much below this mid band that I have in my Bollingers. We bounced off it a couple of times, and as you've been listening to me for a while, you've noticed that I've been a big proponent when we break through this middle band in our Bollingers, be it on a daily or a 30 or a 15-minute, we want to try as hard as we can to stay below it. And that's pretty much what's been happening here. So as this, and it's actually a 20 bar moving average that I use for my middle band. And as we're staying below there, you want to keep short here as we go below it. So keep an eye on that. And again, if we get that big move, I would start buying as we go above 81, 85, 90. And, if we get a nice move above 82.70, I would put on a full-on position, looking again to make new highs above the 84, 10, 20 level that has been our most recent highs. And again, the Japanese are on record as saying that they want a cheaper yen. They're going to do what they can in terms of different quantitative measures that they can do to ease. So it's in the absence of any safe haven buying of yen, I would expect dollar yen to move higher. Let's take a look at dollar CAD. And again, the story with dollar CAD is also one of safe haven in the dollar itself. You get the move that I expect in the dollar, meaning something sub 125 on its way down to 120 in the euro, you could expect that the dollar CAD will take off as well. Dollar Canada has been in this very sleepy range here, 100.50 to 98.55, 200 pip range for the last 2-3 months. again, for now, play the range. If we break that 129.80 level in the euro, expect dollar CAD to blast higher as well. In fact, if you wanted to, you could consider selling euro CAD, but that would be a little more dangerous because, again, the whole euro component in there, if you're selling euros, you're expecting the CAD to go higher. And that is what the Canada story looks like. But for now, I mean, obviously, very sleepy. You don't even get that much yield for it. I'd stay away for it. If you had the ability to do options, I'd look to buy a 10050 to 101 US dollar call. I don't expect the strength in the Canada is not well received by the Canadian government, in much the same way that the strength in the yen isn't, and the strength in the Aussie isn't. So there's quite a bifurcation between the haves and the have-nots in the economic world now, and it's almost that these economies are driven to their extremes, and there's some real pain going on in those countries that are, perceived as doing well and are considered the healthy ones, and in no small way they're actually being brought down by these other economies. So keep an eye on that as well. Any other questions out there? All right, FX Pips. Thanks to you for being so involved today as well. If there's nothing else, let me wrap up and give you a little bit more of my story. I am with Forexfolio, and of course, let me refresh. Forexfolio is a team of experienced financial professionals having a varied experience. We have trading professionals, we have IT professionals, we have sales professionals, and we exist to provide our customers on both the retail and institutional sides with exceptional service, superior products, openness, honesty, and really just assistance wherever we can, be it with whether it's help with an out trade from a broker that we deal with, or helping you write EAs or algos. Whatever we can do, we stand ready to help you with. You can contact us by phone at 1-800-756-7509. You can contact me, paul.spirgel@forexfolio.com. You can hit our website at www.forexfolio.com. Skype us, Facebook us. We're on Twitter. You could follow us, give market updates and economic updates throughout the day. We deal with most of the major brokers. Alpari is our preferred broker. We have a specific spread with them that's tight and has very good execution rates. Again, no matter who you deal with, if you have any questions about the way they're dealing with you, we're more than happy to help you out. If you're trying to deal with somebody new, we can vet them for you or discuss getting you proper spreads with them as well. We have trading signals, virtual desktops. And again, whatever you need. If you have any questions, contact us at any of these means of contact, and we'd be happy to help you out. That being said, if there are no other questions, I'd like to thank the people at FX Street for giving me the platform. And I'd like to thank all of you people for taking time out of your days and evenings to listen to what I have to say. So, anything you might need, let me know. All right. Then on that note, I wish you all a good week, and be careful and good luck with your trading.